Jake Stein has accumulated a $50 million real estate portfolio. He's got 400,000 square feet of building space and 30 acres of industrial outdoor storage. And I think the most shocking part of all that, Jake, is that you did it all with minimal partners. Where did all this come from?
The first year of college, was it 18?
You were 18?
Yeah.
You were 18 when you started
Correct.
wholesaling? Wow.
When I was first starting, the biggest thing that I had going against me was my age. And this guy's not going to be able to close because he's young. And so I was just kind of on a hamster wheel with the wholesaling, and I was always dependent on the next deal. So my goal became I wanted to figure out a way to not have to flip things anymore and to where I could just really focus my time, attention, efforts on building my industrial portfolio.
Business park that you just purchased. What was the opportunity that you found? What was the seller's pain point?
That deal is the most difficult deal that I've ever structured.
Today, I had the pleasure to interview one of my good friends, Jake Stein. Jake Stein has a $50 million real estate portfolio, most of it being comprised from industrial warehouse space. We spoke about how he has over 400,000 square feet of building spaces and 30 acres of industrial outdoor space. I think the most astonishing part of all of this is that he was able to do it with minimal partners by doing creative financing with the homeowners. We spoke about his journey of him starting off when he was 18, going and wholesaling land when he was still in college, and then transitioning into doing owner financing with real estate transactions. After that, he started buying. His first deal was a 4,000 square foot warehouse space, and he was able to leverage that into buying his first 100,000 square foot industrial business park here in Houston, Texas. I think everyone that listens to this is going to get a ton of value, and I would say that Jake Stein is definitely a leader in the industrial warehouse space. If you've ever wanted to learn about industrial warehouses, about the due diligence regarding these business parks and industrial outdoor space, you're going to get a ton of value out of this. We spoke about, doing environmental studies, doing cost segregation, depreciating the assets, 1031 exchanges, and overall how he was able to scale from only doing land to now owning a $50 million portfolio. I think it's an astonishing story that he has to offer, and I think everyone's going to get a ton of value from this. Thank you for watching. Welcome to another episode of Pick Up the Phone podcast. My name is Josue Llanas. I help business owner with people, software, and artificial intelligence. Today's guest is Jake Stein. Jake Stein has accumulated a $50 million real estate portfolio. He's got 400,000 square feet of building space and 30 acres of industrial outdoor storage. And I think the most shocking part of all that, Jake, is that you did it all with minimal partners by structuring creative finance. So welcome.
Thank you.
Yeah.
Thanks for having me.
Dude, I'm excited, bro. I'm excited. I've been knowing Jake for a long time, huh?
Yeah, I think we started, what was it, 5 years ago or so? 4 or 5 years ago?
It might have been longer than that.
Yeah, with cold calling and Vancom, and
Yeah.
I've worked with you guys ever since. And we started with deal sourcing, and then that turned into, finding tenants for the business parks and
Yeah.
a whole host of things.
Yeah. Our very first interaction, I think, was in. Do you remember Enid?
Yeah,
Yeah, Enid.
residential wholesaling.
Residential wholesaling. Yeah. So that was quite a bit back. I'm not exactly sure, but we did wholesaling for a while,
Right.
and I was pretty good at dispoing. You were pretty good at acquiring. So
Finding the deals and then,
Yeah. You found the deals. I sold them.
correct.
Yeah. That was good, man. We had a pretty good run there, and then you found the Mecca. You found industrial warehousing, huh?
Right.
Yeah. So we'll talk about all that. I actually want to talk about your story, man. How'd you get started? I think it's not just anyone that builds, number one, a pretty sizable real estate portfolio with minimal partners. And I think it's also more important to know how you got to that point, what got you started, where did all this come from?
Sure. Yeah, so I think more than anything, it's kind of been, a scavenger hunt, if you will. I don't think it's been kind of going from one step and then someone directs me a different path. And that's really how I learned most of, kind of what I've done so far. Started in 2015 or so when I was in college. One of my good friends, his dad, kind of gave me the blueprint to wholesaling.
Yeah.
And he still manages and owns industrial properties. And so I really got started with wholesaling land.
Really?
Yeah, and so to me, it was a lot easier than houses because there's so many, variables with houses and, trying to figure out condition and things of that nature. So,
Mm-hmm.
really, I was just doing, land in Sunnyside and South Union and flipping vacant lots to townhome developers. And so that's what I was doing in college.
Yeah.
Essentially,
What college did you go to?
I went to UT
UT.
Austin. Yeah, I
Austin.
studied finance there.
And you were doing wholesaling over here in Houston?
Correct.
Nice.
Yeah, so I would.
So you were doing virtual wholesaling then?
I was doing, I wouldn't call it virtual wholesaling because I was coming back to Houston.
Mm-hmm.
I was going in land glide
Nice.
and driving for vacant lots. So
Yeah.
I would essentially drive through, these areas and take screenshots of every vacant lot I could, and then, go back to college, go on white pages, cold call all these people, lock up deals, flip them. So that's what I got started doing.
Yeah.
And then I started.
How old were you at the time?
So first year of college, was it 18, somewhere around there?
You were 18?
Yeah,
You were 18 when you started
correct.
wholesaling.
Correct.
I think, for anyone that's listening, a lot of people are like, oh, you need to have money, you need to have resources, you need to have all these things. Everything that you just mentioned, Landglide is $10 a month.
Right.
The white pages are what, free, basically?
Yeah.
There's like a premium subscription, but it's minimal. And so for anyone that's listening, you don't have to be older or have a whole lot of resources or money for that fact.
Right.
Because I'm pretty sure you're broke college kid at the time.
So what I did initially was flipping residential land, and then I started buying some of those residential pieces of land. Those were the first assets that I bought.
Yeah.
So I was buying residential land. Then I started, my friend's dad that kind of taught us about, wholesaling and what to do on that front, started telling me to, direct my same efforts towards warehouses.
Yeah.
And that's really when I started looking for industrial deals. At the time, it was single tenant sites that were, 2 to 3,000 square foot warehouses. I found my first one in, I think it's 2017 or 2018. 4,000 square foot warehouse. I bought it for $100,000.
Wow.
And so I got it under contract. A good friend of mine who's a realtor, she knew a hard money lender, and so she connected me with the hard money lender. I bought it for $100,000 and 10% interest. I stayed in that for almost a year. I think it was over a year because I couldn't qualify for a bank loan.
Yeah.
And I went to a mortgage broker essentially to help me start figuring out how to refinance some of these deals. And he said, all you own is land.
Right.
And that's not what any bank wants to see.
Right.
So the first thing you got to do is start selling this land and start figuring out how to buy, income producing vehicles. And that's really, what kind of guided me away from just, land and towards focusing my efforts on warehouses. So, my strategy became finding industrial deals for me to buy and then simultaneously flipping land as a means of income.
Right. So your flipping land was you making money.
Correct.
Right? And then you started buying the warehouses as a means to hold assets.
Correct.
Got it.
Using, essentially hard money loans to purchase the warehouses. The hard money loans to purchase the warehouses, that wasn't, it wasn't ingenuity on my end at all. It was just the only way that I could finance the deals at the time because I wasn't a bankable client.
Right.
And so, started selling the land at a good time, just given the market conditions. And that wasn't, timed on my end either. That was just because a banker told me to, a broker told me I shouldn't own that land and started moving that way. And I also was doing, initially single family lots, residential lots is what I was flipping. And then that transitioned to commercial flips. So I started, I realized I could spend just as much time, trying to find a 5-10 acre piece of raw land as I, did a vacant, 5,000 square foot lot.
Right.
So I started, moving towards bigger pieces of land to flip, and then I stopped doing assignments and I started doing double closes instead of assignments.
Right. Well, What was the reasoning behind
So
that?
the reason being that people could see what I was making on the assignments,
Mm-hmm.
and I realized that regardless how good, at least with the single with the 5,000 square foot lots, I had the same buyers that I would go to, and I'd always end up making the same exact amount, regardless
Right.
of how good the deal was. I'm
Right.
like, these guys just think I'm worth a certain amount per deal,
Right.
and they were using the price. I kind of had the mindset that they should be they should be focused on their acquisition price as opposed instead of how much I'm making.
Right.
And so I realized I didn't have any negotiating leverage.
Right.
And started learning about how to structure double closes. That being two separate purchase of sale agreements where neither party can see what I'm making.
Right.
Um, and the biggest legal nuance to that was in the event that the contract that I was closing on, if the seller backed out of that, I would be liable for specific performance, with the person buying it for me.
Right.
So, I figured out how to just, put in a clause in the special provisions that, it's contracts contingent on the first one closing. So figured out some of those nuances, and then, really had a good run with the double closes. And, but at the end of that year, I realized that I didn't even have the money to pay the taxes that I'd made on those, double closes and flips because, short-term capital gains. I
Right.
thought I was making really good money.
Right.
I was really paying a ton in taxes. The more I made, the more I wanted to spend on marketing. And so I was just kind of on a hamster wheel with the
Right.
wholesaling, and I was always dependent on the next deal.
Right.
And I had very little control over there constantly being a new next deal, and there was nothing that was reoccurring. It was all, very much, having to find the next thing to keep the hamster wheel going. So my goal became, I wanted to figure out a way to not have to flip things anymore, and to where I could just really focus my time, attention, efforts on building my industrial portfolio.
Right.
And so what I started to research is the idea of, seller financing residential houses. And so what I started doing was buying houses, fixing them up, seller financing them, and then doing note receivable loans.
Were you buying them with hard money or?
So I was buying them with hard money.
Okay.
I was fixing them up with hard money. I'd then line up the note receivable loan. So essentially at closing, at the time that I would, I'd buy the house, I'd fix it up. At the time that I was selling the house,
You were refinancing.
I had the note receivable loan there. So it would pay off the hard money lender. So for example,
What's a note receivable loan?
so if I'm, for example, if I bought a house for 40,000 and I put 20,000 into it, so I'm all in $60,000.
Right.
If I'm selling it for 100,000, I'm creating a note, and then essentially borrowing against that note, which is an asset. I have a so then I'm taking a note receivable loan. So I'm essentially borrowing against the asset that I'm creating, and using
The asset being the note
the
receivable.
note
loan.
receivable.
Right.
Yeah. So therefore, I'm using that bank loan, note receivable loan, to pay off the hard money lender.
I see.
So then I'm just taking the spread between the equity that I created in the house,
Right.
as well as the interest spread between that and what I'm paying the bank. And so that gave me, those are 30-year notes too. So that gave me the reoccurring cash flow. So I did 12, 13 of those,
Nice.
which I still have now.
Real quick, and let's pause because you covered a whole lot, and so for
Sure.
a lot of people that are listening to this, they may have very little knowledge of real estate or how it all works. So we're going to break down a couple of things because I think it'll be important for them to understand all of this. An assignment contract is basically when you get into a contract with a homeowner or just someone that owns a piece of land, whatever asset it is. You get under contract, and then an assignment contract is you sign another contract where you sell your interest in that first contract to the end buyer. And when you sell that interest in that contract, that's where the buyer can see that assignment fee that you have, right?
Right.
So that's what you spoke about earlier.
Right.
Then you transitioned into double closes where you create one purchase agreement between yourself and the seller, and then another purchase agreement between yourself and the buyer, right? And so on the day of closing, you close on the first transaction between you and the seller, and then immediately right after, within 2 minutes, you sign another piece of a whole set of closing documents between you and the buyer, and now you have two different sets of purchase agreements.
Right.
Correct?
Correct.
Cool. The only other thing that I wanted to talk about is the creative loan. Is that considered a DSCR loan?
Are you talking about on the warehouses or the single family?
Single family, when you were creating the note receivable loan.
So the note receivable loan, no, it's a. Are you saying the basis? I use community banks like Third Coast Bank, for example, and
the basis loan between you and to pay off the hard money loan.
it's a six. So they do 65% of the appraisal. It's kind of more or less how they factor the.
Okay. And so it's not considered a DSCR loan at all.
No.
So is it more like a commercial loan?
Yes, exactly.
Okay,
Yeah.
got it.
So
And that's something that you developed because you had a relationship then at that time with a banker.
with the bank, yeah. So I started out initially. I was doing note receivable loans as hard money loans, if that makes sense.
Mm-hmm.
So I had I had two different lenders, and we don't need to get too nuanced with it. But I basically had one lender that was doing the acquisition and the improvements to the house,
Yeah.
and then another that was doing a note receivable loan and paying that first lender off.
Basically, like basically refinancing your asset now into a 30-year product versus an acquisition product.
Correct.
That's
So it's a note
short-term.
receivable loan. It allowed me to kind of demonstrate proof of concept, and then I started using community bank to kind of.
Oh, I see. Got it. Okay, cool. Yeah, and I think it's important for a lot of people to understand this, right? So that they can understand how these deals are structured, because there's so many ways to structure real estate deals, right?
Right.
And so you had a relationship with a hard money loan to buy the assets, and then you had another relationship with another lender that gave you the long-term financing to be able to have the basis loan and then create that note
Right.
receivable.
Right. And the other component to this is it's neither the community banks nor the private lender that I was using would do a 30-year note. So they'll do 5-year term. So you essentially have to refinance it every 5 years.
I see.
But on the other hand, your borrower is paying down the principal every year.
Right.
So it works out to where, your returns are still in place, and, you just refinance, whether it's with a community bank or whether you sell the notes. And
Got it. Okay, cool. That's awesome, man. That's great. I think what's also important to backtrack a little bit is you were doing all of this stuff while you were still in college also, by the way, right?
correct.
So you're in college, you're flipping land.
Right.
And by the way, Sunnyside and Southeast, these are areas in Houston that are pretty, let's call them transitional.
Transitional, yeah.
Yeah. They're they're up and coming areas. They're
Right.
they're pretty rough back in the day.
Right.
And you must have identified some sort of progress that was happening in this area, maybe
Yeah.
some development that was happening.
It-
And this is why what's the reason that you decided?
Yeah,
to
I mean,
go
it was
into-
really. I wish I could say it was my idea. It was not my idea.
Yeah.
One of my, my good friend's dad, very much directed me over there, and
Yeah.
saw that I really wanted to get involved in real estate. I had a lot of energy and passion, and I've always been very entrepreneurial. When I
Yeah.
was younger, I wanted to be an inventor, and
Yeah.
I'd always come up with inventions and
Yeah.
find out they were patented and then
Yeah.
sob about it for a day or two. But so I always had a lot of energy that I wanted to put into a business.
Mm-hmm.
So, with a little bit of advice and guidance, I was able to just channel all of that energy.
Mm-hmm.
And, with finding pieces of land, I would cold call, like crazy.
Yeah.
My roommates in college, make fun of me for it. I'd close my door and I'd just be cold calling, and
Yeah.
I'd be watching football or something.
Well, I think you got the last laugh now.
Yeah, I mean, I think there's probably a healthy medium there. I think,
Yeah.
but it's
Well, I think, it goes to show like what your goals are. For some people don't have the goal to a massive, real estate portfolio, but, you obviously did. But for anyone that's watching this, I'm assuming that they probably have a similar goal of having some sort of financial freedom through real estate, right? So this is something that you did that other people can do also. Hey, listen, if you're in college, shut yourself off and do what Jake is doing and start, wholesaling land, for example, or anything else, in today's current market
Right.
to be able to achieve your goals
Yeah.
that you have. So it goes to show a lot too that if you have a goal, all you have to find is probably the right mentor, right? It
Right.
kind of sounds like you were blessed to have to be around someone that was able to guide you. And I think for anyone that's out there that's listening, seek and you shall find, right? If you
Yeah.
find if you're looking for a mentor, the mentor will appear. And I think that's what happened to you, right?
Yeah, and what's interesting is it's kind of like I mentioned with the scavenger hunt. The mentor that helped me kind of in my first stage was very much just for, involved in kind of guiding me towards industrial as an asset class.
Mm-hmm.
The next level of mentorship came from someone that I didn't know previously.
Mm-hmm.
And the way that I actually connected with him is I was cold calling. And in fact, the first big warehouse deal that I did
Mm-hmm.
was a 53,000 square foot building.
Mm-hmm.
And the guy that lent the entirety of the purchase price was someone that I met cold calling.
Really?
And so that was my first big hard money lender. He gave me favorable terms. I knew if something happened, he'd be there to help me out.
Yeah.
Yeah, and so that was a guy I met cold calling.
Yeah.
And the second, I mean, he was a good resource from a financing standpoint.
Right.
But one of the most influential people that I met is through cold calling again.
Right.
I was calling on a site that was far bigger than anything I was capable of taking down at the time,
Right.
truthfully. But he was nice enough to go for coffee with me, build a relationship. And he said, after, kind of hearing me pitch enough things at him, he said, well, why don't you just come take a space in my office?
Mm-hmm.
And I don't know exactly how we're going to work together, but just take a space here and let's organically see what happens.
Yeah.
And I was the only one in the whole company. I should say I was the only one in the whole office that didn't work for the company.
Wow.
And I was like this mystery man. Like
Yeah.
people would wave to me and say hi to me, but then no one knew what I did or who I was.
Yeah.
And anyways, he's the one that guided me towards business parks.
Mm-hmm.
And I was looking at previously I was buying 4,000 square foot warehouses, smaller businesses, dealing with smaller businesses. And he guided me towards business parks, which are essentially 100,000 square foot facilities that house 1,500 square foot businesses on average, and you have an office, a warehouse, each one being its own meter. So that's what I started focusing on, very much because of this mentor.
Wow.
And that's what kind of transitioned my career and gave me a little bit more scale, and the ability to do less deals but bigger deals and grow my portfolio in a meaningful way.
Wow, it's incredible. I think success is a mixture of opportunity and hard work, right? And I think you definitely embodied that, right? Because things don't just happen for people, you make them happen, right? But you kept on knocking on those doors, you kept on knocking on those cold calls, and through your hard work and your effort, you were able to meet this person that set you on track to be the person that you are today, right? So I think there's a lot to say about both, hard work and opportunity. And I think opportunity is created through the hard work and the effort that you do. And I mean, you definitely were doing that even at a very young age, right? So, I mean, how old are you now?
28.
You're 28.
Yeah.
So, I mean, you started 10 years ago, right? And now you've amassed this portfolio. Success does not happen overnight either. It takes a long time for all of these things to kind of snowball into effect. So, kudos to you to do that, man. And I think it goes. It shows a lot of. It shows a clear pathway for anyone that's out there listening to this to want to, if they want to create something of themselves. I mean, we live in the land of opportunity, right? All you have to do is go out there and knock on doors, and the doors will open. So, so let's talk about this, man. How did you transition then from your wholesaling land, then you're creating the creative finance and everything? At this point in time, you're probably making a little bit more money, right? You probably have, you did 13, so you probably have a good amount of income now.
Yeah, so that was, and that's another mentor that actually I met from from you,
Yeah.
Craig
Craig.
Couch.
Yeah.
And that's how I got started with even the seller financing on the houses, just through Craig, who I met at your event.
Yeah.
And then that gave me kind of the ability to start, focusing on what it is that, I wanted to, focus on in the industrial world. And in fact, when I moved into my mentor's office,
Mm-hmm.
essentially, I was doing seller financing.
Mm-hmm.
So I was seller financing houses, and I was in his office, and he knew I wanted to be doing industrial, but at the time I was trying to figure out my reoccurring revenue before I could channel all my energy there. And
Right.
so the first business park that I bought was in May of 2023.
Okay.
And I owned industrial up into that point, but that was the first sizable business park.
Yeah.
I bought it from a guy who'd owned it for 40 years, and the in-place revenue was 26,000, 25 or 26,000 May of 2023.
Mm-hmm.
It's about 113,000 a month right
Mm-hmm.
now. So
you grew it from 26
26,000 a month to
to 100 and what?
it's 114, 115 range. Yeah.
So close to 100,000 in income that you increased.
Correct.
Is this yearly income?
Yeah, no, this is monthly.
Monthly income.
Yeah, from that business park.
Okay, so your first business park was generating 26,000. You grew it
A month, 26.
26,000 a month, and you grew it to 113,000. So that's if you know commercial real estate, cap rates, you know that you increased a heck of amount of equity on this deal.
Right.
Yeah.
So that deal, I wasn't expecting it for it to create as much of a cash flow situation as it did. I was focused more on kind of how I looked at my previous deals as building my equity, building long term. This deal, in fact, so when I was buying it, I was negotiating with the seller, and he was going back and forth, and he essentially told me, I'd be open to selling at some point, but only if something were to happen to my staff who've been there for 40 years.
Right.
He said, right now I'm not a seller, but if something happens to them, then I could become a seller.
Right.
And I was really bummed about the situation. This is when I was purchasing it.
Yeah.
And, I was on a walk the next day, and I thought about it, and I said, well, why don't I just make them an offer and just throw it out there? So I typed up an offer, and I said, by the way, if something were to happen to your staff, or, I'll keep them for a year, essentially. So I said I'd be open to keeping your staff for a year.
Mm-hmm.
And, that was enough for him to respond to me and say, let's meet tomorrow. And that's what got me a quick response.
Wow.
And what I realized from that situation is the money was not the drive. He wanted to get a fair amount in his mind based on what he bought it for 40 years ago.
Right.
But the differentiator with me, as opposed to a lot of the other suitors and people who had reached out to him in the past, is I identified his main problem.
Right.
Which is the people.
Right.
And so me keeping them on staff for a year, that's what got me the deal.
Wow.
And I mean, the property manager was 83 years old, and I don't think she did a single thing for me the whole year she worked there.
Yeah.
And that was all right by me.
Yeah.
The maintenance guy, same thing.
Yeah.
I added their salaries to the purchase price. I took the L the day I did it. I wasn't expecting much.
Yeah.
So, anyways, I wouldn't hire those people, electively.
Right.
Given the circumstances, it made sense.
But you got the deal because
Correct.
of it, right? So understanding the seller's pain point, right?
Right.
Or his driving factor for being motivated to sell,
Right.
and then giving them an offer that meets their criteria
Right.
is what got you the deal.
And he financed almost the entirety of the deal.
Really?
At 4% interest only.
Wow.
So that became a cash cow.
Wow.
And that, very much just kind of gave me, horsepower to go into the future deals. It gave me the conviction, the confidence to grow.
Right. And this was the business park?
Yeah, this is the hobby business park.
Okay, I see you're wearing a hat, right?
Yeah, hobby.
Hobby business park, yeah.
But yeah, I mean, it was it was a situation where understanding the person was a lot more important than any real estate component, if that makes
Right.
sense.
Yeah.
So I think like the biggest thing that I've learned in real estate thus far is it's a people's business.
Right.
And at the end of the day, like, whether you're doing, residential and you want to move to industrial, or you're doing moving to, apartments, multifamily, I mean, there will be like funds that you deal with, and they're, IRR driven, and, you probably won't get a good deal from them. But by and large, when you're dealing with, mom and pop sellers or people that have owned, these facilities, regardless of what kind of facility or place it is, like, most of the time they're driven by, do they like you? Do they feel like they can trust you? And do they feel like you can actually close and perform?
Right.
And I found that, when I was first starting, the biggest thing that I had going against me was my age.
Right.
And looking young, and, people kind of saying, I like you kind of thing, but I don't really trust that you can actually perform.
Right.
I even had one situation where I basically had to put down 15,000 non-refundable money because I looked younger than the other guy. I was buying a warehouse, or I was about to be under contract to buy a warehouse. He had a broker friend who he had, engaged last second to join, and facilitate. And his broker friend met me there, and basically, was, saying this guy is not going to be able to close because he's young.
Yeah.
And he knew of a buyer who he felt more comfortable could close the deal.
Right.
And so I had to put down $15,000 non-refundable that day.
Right.
I knew the property. I'd already done my due diligence on it prior to that.
Is this a hobby business park?
No, this is
Another one.
a smaller deal. But
Yeah.
I guess my point being, I had to overcome a lot of that, and it was difficult on the front end.
Yeah.
But once I had a little bit of a track record and could leverage other deals, then it became, one of the biggest differentiators to my profile. I mean, being able to meet a seller, they like that, you're young. They like that you're like, doing something different than what most people your age are doing, and they want to help. By and large, as long as they feel like you can close.
Right.
So.
Right. I mean, there's a lot to say to that, right? Because a lot of people use this as an excuse or as a limiting belief that, hey, maybe because I'm too young, I'm not going to be able to go and make these large acquisitions. But if you just figure out a way to still overcome that barrier, and if maybe like you did, create a track record or create like a creative financing for yourself, then you can still overcome those objections that a seller's going to have. So,
or if, partnering with someone, I mean, I could say like, what I would personally like help with, I mean, for anyone that's listening, is deal sourcing. And, I'm happy to come into the deal as, earlier on during negotiations, to leverage, my track record, to leverage the deals that I'm doing. I mean, if someone even wants to say they're, a partner early on to, to create that sense of conviction.
Yeah.
I think that's where, having the track record can just help solidify the deal.
Yeah, absolutely. And I mean, in this regard, I mean, now you have a pretty sizable track record. Now you have, possibly the portfolio to now come into the picture on a deal and say, hey, listen, I have this, and this that I've done. I own these parks. I'm partnering on this deal. So let's, anyone that's listening could definitely even partner up with you.
Yeah.
And you can figure out some sort of equity spread where you bring in you could be, like a GP, so to speak, and provide, your portfolio to get the deal done.
Or just, whether it's an assignment fee or double close. To me, I mean, having been through kind of the wholesaling experience and having done that to start off, like I'm very sensitive to people that are sourcing deals. I know how difficult it is to, to find those opportunities.
Yeah.
And I'm focused on, what I'm paying, not what someone else is making.
Right.
So, if someone wanted to double close the deal to me, sign the deal, it's, I'm open to
doing something like that.
People making money essentially.
So let's back up real quick because for a lot of people, we've mentioned business parks, right? What is a business park?
So a business park is essentially a facility where you have a bunch of small businesses operating, right next to each other. So each unit in a business park is about 1,500 square feet, at least the facilities that I have. So you have an office, a small warehouse, and a restroom in each unit. Each unit has its own electric meter, so it's very much like having your own warehouse space, essentially. So some of the common tenants are, AC companies, e-commerce groups, plumbers, painters, carpenters, really all kinds of small businesses that have a need to have some level of space to store inventory, an office to do whatever they need to administratively throughout the day, and have it's the least expensive way to essentially store your inventory and run your business. And my logic there is we're only moving more and more towards an e-commerce based,
Yeah.
it's in and so like having a retail storefront versus having a warehouse space with an online presence,
Right.
you're better in not all instances, but in a lot of instances, you're better off using the extra money that you would have spent on a retail frontage
Hmm.
towards online marketing, and then having your inventory and office in a less expensive you know warehouse space, if
Yeah.
you will.
Yeah. No, that makes sense. So that's what the business park is, right? Now let's talk about how you grew that amount from 26,000 a month to over 113,000.
It was all Vancom.
That was all Vancom. How do we make that happen, Jake?
So I guess I'll talk about the problems because a lot of it was just fixing the issues that were there. Um, Previous ownership didn't have any online marketing. All they had was a sign, in the front, and it's not even on a main road. So you're just really getting whatever traffic drove down the street that day.
Right.
They weren't doing any make readies, so they were leasing units as is, with mold and all kinds of stuff that just needed basic
Wow.
housekeeping, cleaning, and paint, just, really the basics. So I think, one of the biggest things as well was just security.
Right.
And I was able to see, the best investment that I found in business parks is a gate,
Hmm.
and, just very basic gate, cameras. And, people are looking at these facilities not as, they're not expecting it to be a beautiful place for people to come. They want to know that their stuff is going to be safe, that they're going to be safe, or whatever personnel they have there,
Right.
and that their inventory is secure. And so as long as the location's good, as long as it checks the boxes, then people are happy. So like understanding what the clients are looking for
Hmm.
and building something that accommodates their needs,
Hmm.
and then having online marketing, and really creative marketing. I mean, truthfully, Bandcom and cold calling and Facebook Marketplace,
Hmm.
CoStar, LoopNet, just really being like an octopus with a bunch of marketing tentacles,
Right.
and then
So
delivering a good product.
what was the initial price per square foot going in, and then what did you increase it to?
On the rental
Yeah,
side,
on the rental side to your tenants.
so one thing to note, not to make this more complicated, is I converted everything from gross to triple net.
Hmm.
So
So
just
can you explain that for
yeah,
everyone that's listening?
so gross means that basically all bills paid for by the landlord,
The owner.
the owner,
Yeah.
and then triple net is where the tenant's essentially responsible for everything, except usually the roof and the structural.
Hmm.
But for example, the taxes are pro rata. So if you take 1,000 square feet and it's 100,000 square foot business park, you're paying 1% of whatever the total taxes are and whatever the total insurance is. Anything that takes place within your unit in terms of repairs, you're signing a lease day one that's saying you've inspected everything, and whatever happens in there, if it's not roof or structural, it's your responsibility. So it allows for, a lot more predictable cash flow as well. Because, I mean, you could say your gross rent is, one thing, but you have to factor in all the miscellaneous expenses that can occur throughout the year. So, if I had to look at it on a net basis, it was probably $3 a foot net. And now it's 11 or 12 net.
Wow, that's a pretty big jump there.
Yeah.
Yeah. So by creating the security, by making the facility nice and welcoming, and then by doing triple net lease, you were able to raise the rents from 3 to 11.
Yeah, I mean, one of the biggest things, and the majority of the tenants that were there before left. A lot of them weren't even legitimate businesses. It was just so inexpensive that they were able to justify using it as storage.
Right.
And the thing that I've realized is, if you're begging someone for their last dollar, it's a much more difficult proposition versus providing a product that is suitable for businesses that have, the capital to pay, for a space and to pay for what it is they need.
Yeah.
And so that's kind of that was a big part of it, just bringing in a different caliber of tenant profile.
Got it. So now you have all these new tenants that are in there, all these new actual business owners that see the facility as a way for them to make more money because they have a nice, cozy environment that's predictable for them too, right?
Exactly.
Because they have the security, they have a nice facility.
Yeah, and one other crucial component is on the leasing front, doing the leasing in-house as opposed to with a broker.
Right.
And, I mean, nothing against commercial brokers, but, these units, when you're talking really small units and really small commissions and, tenants that a lot of times don't show up to the day that you're coming to do a tour, it doesn't, if a broker has the ability to lease, a 30,000 square foot building, that's a single tenant deal versus going and driving across town to lease 1,000 square feet. A lot of times you don't get the attention that you want.
Right. So then by you giving them the attention, now you have a little bit more control.
By doing it in-house, yeah, because, then you have someone who's dedicated to it. And that's also, I'm looking to hire more leasing people in-house. So if there's anyone that's listening that, is looking to do that.
Yeah. And I think it'd be a great opportunity for anyone that's listening to this to come learn from you, right, and work directly with you, help you lease out your units, and then also learn from you, right, and see everything that you've been doing. So, man, that's pretty amazing. So that's just this business park, right?
Right.
Yeah. Is this where you kind of got the itch from to get more into industrial after you saw the other value and all? Well, I wouldn't even say the value. I think I would say more it's like a need, right? Because I feel like there's maybe not a lot of investors out there that are looking at mom and pop shops to go and purchase them. I'd say maybe, like larger funds or larger acquisition companies are probably looking at maybe a much larger asset versus, smaller assets like this where there's the in between.
Right.
Right.
Yeah, I mean, I think this deal, that deal transitioned my mindset from, I thought about, how many deals would it take for me to make the same amount of money that I did on that, create the same amount of equity that I did on that one deal. And, there comes a, time where I think you think about it and you only have so much time in a day and you only have so many days in a year. And so finding opportunities to create true scale and return on effort became something that I paid much more attention to after that deal.
Right.
And so, if I was looking for a 4,000 square foot warehouse before, I had to find a seller, put the deal together, do the environmental, do all the due diligence. It's versus a 100,000 square foot deal, it's the same environmental guy I call. It's a lot of the same patterns, except one, you're able to achieve so much more scale and growth versus a smaller deal.
Right. But there is something to say though about getting that initial 4,000 square foot warehouse that sets you up to getting a much larger facility.
The first 4,000 square foot warehouse was a lot harder.
Yeah.
And a lot more important.
and a lot more important
Yeah.
because it taught you the game, it taught you the process, it taught you everything, all of the nuances of putting the deal together, right?
Right.
That by the time that you got to how many square feet was the business park?
100,000 square feet.
So 100,000 square feet. Now you've been able to see the process. Now the only thing or the only mental barrier that you have to face at that point is, okay, it's just going to be a lot more money, right? So it's a lot more risk. But at that point, you already have the confidence of actually getting the deal done,
Yeah.
right? So there is still something to be said about doing those small deals initially to get the process going and then being able to transition to something larger,
Right.
right? So I think, in life, everything, there's stepping stones to everything, right? And it's okay to start small. It's okay to start with a 5,000 square foot land in Sunnyside, right? Because that can initially transition into a 100,000 business park
Right.
in Hobby, right? So, it's all just levels to the game,
Right.
and the levels get bigger and bigger as you gain confidence, as you gain more money, and as you build more relationships with people,
Right.
right? So that's a wonderful journey. Awesome. Now let's talk about industrial outdoor storage, right? Because that's something that you've also been doing.
Yeah.
What is industrial outdoor storage?
So industrial outdoor storage, which I'm obsessed with at this point. I mean, like, I spend too much time, researching and learning about it. I'll say, the business parks, which I just took down another one recently in March, another 100,000 square feet.
Yeah.
So that's in the midst of stabilization right now.
Mm-hmm.
And the business parks are great, and I could talk about them all day as well, but they're very management intensive. And,
In what sense?
everything on the stabilization front, you've got a lot of tenants, so across the business parks, I have 200 plus tenants right now. And they're small businesses. So inevitably, some go out of business, some, when you have, that many small units, you're bound to have problems that arise. They're not CVS or Walgreens, they're small businesses, so they're triple net, but there's still management hurdles that accompany them.
What are the common pain points or common issues that you see with these small tenants?
I mean, everything from going out of business to, I'm responsible for the roof, but if the roof leaks, now you've got, water inside the unit. So now you got someone working inside the unit. You kind of broken that barrier of the triple net ordeal. So, I do my best to keep that triple net item in line, but every once in a while, you do end up doing maintenance kind of work. So, I say that, just because for comparison, I guess my point with the second, business park is that's, in the middle of transition now is, I wouldn't want 100,000 square feet today, business park wise, just because I'm in the midst of stabilizing the other one.
So it takes a lot of energy to
Yeah, it takes a lot of energy, bandwidth, horsepower. Whereas industrial outdoor storage, these are single tenant sites.
Okay.
Single tenant being, one tenant occupying each site,
Mm-hmm.
and you're dealing with really big companies.
Mm-hmm.
So, for example, I have one site that's leased to PCI, which is a big contracting company. They do $3 billion a year,
Mm-hmm.
national company. I mean, you buy deals like that, and you don't ever think about them again. It's like you think about them when you're structuring them on the front end, but then they're really hands free. But
Because it's all just outdoor.
because you're dealing with such big tenants and because they're truly triple net leases, they're responsible for everything.
Yeah.
But to take a step back, industrial outdoor storage is really, there's sites that have 20% or so less coverage. So that meaning 20% or less of the site is improved. So for example, on a 100,000 square foot site, that would mean 20,000 square feet of building or less.
Okay.
And so the focal point of these sites is, the land that's outdoor for storage.
Okay.
It's stabilized land with, crushed gravel, crushed limestone, where, you have equipment rental companies, fleet services, bulk material yards, for listeners, I guess, thinking about it, things like United Rentals, when you see those on like the side of the highway, and they have all those, all that equipment outside, those are industrial outdoor storage sites. And what
So have you already done some deals like this?
yeah, so this year I've done 4 of them,
Nice.
and on the 5th right now.
Very nice.
And
So you only have 5 total so far?
I have 5 total, right?
So let's talk about one of these deals. Let's talk about like numbers, like what was the acquisition price? What was kind of like the negotiating factor to getting these deals done?
Yeah, so well, I can go through a few. Each one has its own story, of course. But
Yeah.
the first one that I did was essentially the guys that were selling it to me used to work for the company, and they'd worked there 40 years, and they had some type of agreement with them where they were allowed to lease to the company. It's a kind of grandfathered ordeal.
Mm-hmm.
And so it was the only piece of commercial real estate that they owned. And they'd retired for the company and just kind of owned that piece of real estate that was leased to PCI's company.
Yeah.
And PCI was paying 8,000 to, or I should say they still are. They're paying 8,250 a month, and market rent over there is about double that.
Mm.
And it's just kind of when you're dealing with a company this large, their goal is to maintain operations.
Right.
So, unless I was overcharging them, or unless there was a very big need for them to leave,
Mm-hmm.
it's super expensive for them to get their stuff and move.
Right.
So you got a lot of leverage in that regard. And as long as you're charging a fair rent, a rent to market opportunity can be, really powerful in those situations. So like for that example, they've got 11 months left on the lease. I did a seller finance deal. The sellers, I bought it for 1.4 million.
Mm-hmm.
The sellers, based their valuation, off of the in-place income. So I bought it for an in-place 7 cap, which is market from a cap rate standpoint.
Mm-hmm.
Cap rate being, essentially, the return on cash that the return that an investor would get if they had bought it in cash.
Right.
Cap rate. So basically, by being able to double the income, essentially double the value. And so, I bought it with 11 months left on the lease. The sellers financed it, and I told them, well, I need the financing. I need to be making money at 82.50. So the financing is 6% interest only, so I'd have a margin at 82.50. But they didn't know that the rate was about half the market.
I see.
So that's a classic rent to market opportunity. You don't want to have too long left on those leases, so really ideally under 18 months.
Right.
On a rent to market deal.
Yeah. So on the rent to market deal, when you were doing your due diligence, did you have a conversation with the tenant, with the large corporation, to have those rents be increased at the end of the lease?
No.
You haven't.
No. The way that and that's kind of a tricky subject, because first of all, you have to have the conviction when you're buying it,
Mm-hmm.
that if the tenant were to leave, you need to know your numbers and know that, know what the rates actually are.
Right.
Because if you're dependent on that tenant to stay, you're not going to have that assurity.
Right.
So what I did was, I knew the market. I had good comps. I knew what I could get there with or without the tenant staying.
Mm-hmm.
And you don't want to give them too much time, because then you're ringing the fire bell and, giving them a year to go look for something that's a better deal. So you want to you do want to be conscientious about it. So I did 6 months. Give notice, give them time to
So at the 6-month mark, whenever they have only 6-month mark left on the lease.
give them some time so they don't feel like they're getting their back against the wall. But so it's also not too early.
Yeah. If you gave them a year, then you would give them time to kind of consider their options and maybe.
Right. And I think I think for anyone that's listening that's looking to transition into industrial, outdoor storage is the best place.
Mm-hmm.
It's really straightforward. You're dealing with one tenant. The most unique part about it is the seller profile. So business parks, you're dealing with investors, and strictly investors, because they own it for investment purposes. They're leased to a bunch of small tenants.
Yeah.
With these outdoor storage facilities, a lot of times you're dealing with owner users, and you're dealing with people that have owned the property for their business.
Mm-hmm.
And it's been just kind of a byproduct of their business. So, they've been focused on their company, they're selling their company or whatever the situation might be, but the real estate is just something that they have
Right.
rather than something that they're used to using as a, as an investment mechanism.
Right.
And so, you're dealing with a lot of times mom and pop sellers where they're not viewing it on a cap rate lens. They're just viewing it as a place that they store their equipment so they can operate their business.
Right.
And now you're kind of repositioning it. So the first example was a little bit different just because they didn't own the company, but it was similar in the sense of like they're not real estate people. It's the only commercial property they own. There was a tie to the company that was there. So, and I've seen those kind of opportunities quite a bit. In fact, in outdoor storage, there's right now it's about 60% owned by owner users
Okay.
and 40% by investors. And I see that changing pretty quickly.
Where do you get these figures from?
So I stay pretty in tune with outdoor storage. I was actually at an event 2 weeks ago in Dallas.
Yeah.
That was strictly outdoor storage convention.
Nice.
So it's just a bunch of people. One thing about sharing comps and people that are in the space, a lot of people keep the comps very close to their chest. I mean, there are only a handful of brokers that are super active in this niche. And so it's difficult to figure out what things are actually leasing for unless you have a broker who has that information, who has that data. You go on, if you're dealing with apartments, you go online and you could see what things are leasing for, and it's pretty easy to gather what rental rates are and what, things are going for. With outdoor storage, it's difficult unless you know the right people, you have the right data, and ultimately, it's the rent that drives the valuation.
Right.
So if you don't have those figures, you have no way of knowing how to value these things, which makes it difficult to break into
Right.
if you don't have any resources in it. But it also creates a lot of opportunity because there's a lack of knowledge and information on that front.
So what has been the best resource then for knowing the market rents and the cap rates for these outdoor storage spaces?
It's really been, and I've seen this as kind of a reoccurring theme through like a lot of real estate, just knowing the right people.
Yeah.
Knowing who to ask what questions to. Because there are a lot of people that will, they want to give you an answer to everything.
Right.
But they're not qualified to give you an answer to everything.
Right.
So being able to know, this is a guy that I know I can ask for lease rates, and I know he's on point, and I know he does this day in and day out, and I know the data he's giving me is stuff that I can count on.
Right.
So developing those relationships, developing conviction in those people, and then I've seen that, good people usually introduce you to other good people, and that kind of starts the cycle there.
I love that. Yeah, real estate is very much a people business, right? So it's all about finding the right people, getting around them, and then, like you said, it'll just open up doors to more people, more resources that have the knowledge that you need to make decisions.
Right.
Yeah. So that was your first deal. Let's talk maybe about another deal.
Yeah. So most recently, I guess this will be my best deal. I'm not gonna wood you. I bought a deal that's right off of 288, and I guess one other thing, there's got to be a driver as for why an outdoor storage site is good.
What's the driver?
So some of the common drivers are being close to a port, being close to rail, being close to an airport, being close to a highway. You got to think that a lot of these companies they're logistics related businesses.
I see.
So they're thinking from an operational lens. And when you're thinking about buying a site, like you want to put yourself in the tenant's shoes and think about what is their GM who's going to look at this site. What's he going to be looking for?
GM being the general
manager. Yeah.
Okay.
What is he going to be looking for?
The decision maker.
What are his pain points going to be? Because if you have a site that has everything going against it except a good price, it's the wrong site. And so, finding quality locations, like this one that I just bought, the deal there is the guy who sold it to me, ran his business there for 30 years. And so he bought it for, next to nothing 30 years ago, unwinding his business and actually downsizing, not completely selling it, but downsizing. And, he bought it super inexpensively. I built a good relationship with him, and he wanted time. He's got all of his equipment there, all of his, and even staff is in the office currently. That property is, it's 20,000 square feet of building on 11.2 acres.
Okay.
And so basically, going into it,
What did the owner do for business?
trucking company.
Trucking company.
Yeah.
So he has like an office space.
So he has, in the warehouse, there's about 2,000 square feet of office in the front, with parking for the employees, and then, warehouse space for, servicing the trailers and things of that sort.
Okay.
But one of the most difficult things when you're going to get financing on these assets is, is there a tenant in place?
Right.
Or is it speculative? And so, in this situation, what I was able to arrange for is I bought it for 2.3 million.
Mm-hmm.
I got the seller to pay essentially 17,000 a month net, on a 12-month lease.
Because previously he probably wasn't paying for rent if he owns
Correct.
the
Yeah,
building.
that's right. Right.
So you had to create a lease basically.
So it's sale leaseback. But then, I was putting that together and I thought, well, I'd like to start marketing it right away. And if I find a tenant, well, then I need to have like the flexibility to get him out.
Right.
So I got him to agree to a 12-month leaseback. So it's kind of a one-way deal where he signed, he couldn't back out of his agreement with me.
Right.
But I could give him 90 days notice at any point to terminate it. So signed that.
Sounds like a great agreement here.
It's a good deal, yeah. And
yeah.
so he signed that. I mean, really nice, easygoing guy. And I started marketing it for lease, did renderings. The site has it was previously used as like a steel yard.
Mm-hmm.
So I don't know if you've seen those where it's kind of grassy portions in between with roads that kind of make like figure eights, and then they lay steel on the grass.
Yeah.
And so basically the improvements that I'm doing there is I'm stabilizing, bringing in crushed gravel. So it's usually you have like a slurry base on the bottom, and then you bring in crushed gravel. It's usually like 10 inches to go above that and have that all contiguous, so that it's one big yard essentially.
Yeah, all uniform, basically.
Correct.
Outdoor space.
Correct. So the way I started marketing it is because it's two different addresses technically.
Mm-hmm.
I had two different options. One being the building on 5 acres, and then another being the building on the entirety of the property.
Another 5 acres.
Yeah, I do have to put in. I lose a little over an acre to detention, because putting in the gravel impervious coverage, you need to put in detention.
Right.
And so I have to allocate a portion of that.
So for everyone that's listening, what's detention?
So detention is for flooding regulations and requirements. It's a cubic measure that the engineers put together to kind of fit the water detention rate. So that's where it's a flood measure.
Right.
For the city.
Right. So the city's the one that makes these implications. They're the ones that impose these restrictions.
That's right.
Right.
So
you need to have all of this knowledge going into a deal to know how to put it all together. Right.
So that's good architect, good engineer. Started marketing the property. Essentially pre-leasing it, because I want to have it leased before I gave him 90 days notice. So leased it right away. And when I say it, I leased 3 acres right away to a collateral recovery. It's a repo company, and they're paying a good rate. And then the other portion should be leased to United Rentals. So finalizing that now. Nice. But we're pretty far into the legal process, so that'll be my best deal so far.
Love it. So let's talk about the numbers. What were you able to increase in terms of valuation?
So bought it for
2.4.
And I had the wrong number in my brain for some reason. It's 2.8 was the purchase price.
Okay.
And then spending about 1.1 on CapEx, and then going to spend about 200,000. And
what's a 1.1 on?
So that's stabilization. I mean, it's a lot. I mean, you're talking 5.8 acres of gravel to fill everything out.
It's a shit ton of gravel.
It's a lot of gravel.
Yeah.
So give or take, it's be like 4.1 or 4.2 million all in. And that's with, brokerage fees and everything.
Right.
And it'll be $7.5 to $8 million valuation.
Nice.
Yeah.
And
But a
that's
lot of that's, based on the tenant quality. I didn't expect for, United Rentals to be the tenant there.
right.
And
How were you able to find them?
it's a 15-year deal. That's my broker.
Your broker found them?
Yeah.
Oh,
And
beautiful.
they didn't even call him. That was a relationship based deal. So he knew he had a connection in Chicago who knew the guy who was looking here and put them together. So that's a good example of like knowing the right people, knowing people that are plugged into the business. Specifically, iOS, because it's its own animal, and
iOS? What's iOS?
industrial outdoor storage.
Got
Yeah.
it.
And just an industrial broker
Yeah.
is very agnostic. Like iOS is like a super small niche within that realm.
Right.
Yeah.
So the rents that you have with the tenant right now, or with the owner that owns it, you created that lease back was 17,000.
17,000, and
What were you able to increase it
so it'll
to?
be at around 43,000.
That's a huge
it's a big
jump.
jump.
Yeah. And so all of this happened because you had the right relationships, again, going back to people business.
The right relationships, the right location, and I mean it doesn't relationships will get you so far,
Yeah.
but then if you don't have the right asset,
Right.
it can't get you all the way there.
No.
So you need the
absolutely.
two things together.
Yeah. And then finding that huge tenant that was able to pay
Right.
probably, are they paying market rents, or are they paying over?
They're paying market.
Market?
Yeah.
Okay. Nice.
Yeah, they're paying like right about right about market.
The
So,
repo company is also
Yeah,
paying market. Nice. So I do see a pretty large barrier of entry here, right? But I think it can be overcome by having, again, the right relationships. And I think you might be probably the best resource out there for anyone that's listening to this. You're already plugged into the community, so if anyone needs some sort of help with maybe either underwriting a deal, or maybe they have an opportunity, they can come to you and ask you all the right questions, or maybe even say, hey, Jake, I have this deal, but I don't even know what questions to ask.
Right.
Can you help me ask the right questions to put this deal together for you?
Right. And I will say, in terms of the type of seller, if you're coming from the residential world and looking to transition, you're dealing with, for the most part, really easygoing relationship-based people.
Yeah.
And so I think where I can hopefully come in to help as needed is, like you mentioned on the valuation front, figuring out, it's great you have a good relationship with them. It's good that that's the hardest part, building the relationship,
Right.
getting to a point of making an offer,
Right.
but, being able to facilitate in, gathering comps and creating the valuation and kind of putting that together.
Yeah, because if I was to come across maybe be an outdoor storage facility, I wouldn't even know where to start with valuation. I wouldn't know where to start. I wouldn't even know how to put an offer together, right? So then I would just come to you and say, hey, listen, I have this great relationship. I've talked to this guy. He likes me. He wants to do business. But now can you help me put together an offer?
Right.
Right. And I think that's where you could definitely come in.
Yeah, and my goal would be to share enough comps to where, you wouldn't need me to put together an offer for each deal.
Yeah.
And like I mentioned before, I mean, my goal is not to see exactly what your numbers are and what you're buying it for. My goal is to create as many opportunities, I mean, selfishly for myself, that I can, have, and then also so I can help as needed. So it's not, it's not one of these things where I'm, looking to be a part of every offer so that I can see what you're making on the deal.
Yeah.
I mean, I'm fine giving comps to say, okay, this is kind of how you value a site. This is how I'm looking at it personally.
Mm-hmm.
This is what my number is, and why, and this is what my number is,
Mm-hmm.
for a site.
Yeah.
Just to facilitate in, better understanding, because it's got to be a win-win for both parties, when doing that kind of situation.
Yeah. I would also say that you do need maybe some knowledge. I mean, because the knowledge to put together, to ask the seller to create a lease back, right, on this deal, for example,
Right.
where does that knowledge come from? How can someone get educated on figure, like, how do you even know where to start to know, oh, I need to put together a lease back with this tenant so that it can be bankable, so that I can actually do a double close, right?
Right.
How would someone go and get that knowledge?
I mean, so a lot of this comes from just like we mentioned before, like trial and error,
Mm-hmm.
like going to a bank with a speculative deal and realizing they don't like it.
Yeah.
You know, it's like, okay, well then how do I make it something you like?
Yeah.
Well, if you had a tenant in there, then we'd like it. Okay, well, you know, what does the coverage need to be,
Yeah.
you know, for you to feel comfortable going into this deal? You know, just getting that feedback, because I think, you know, back to what we touched on before, like nobody comes out of the womb just knowing all this information,
Right.
and there's not really a textbook that you go to memorize it all either.
Right.
You know, it's one of those things where you just have to talk to a lot of people. You have to put yourself in positions that are, you know, where you don't, you know, you might feel like you look like an idiot for a second asking a question, whether it's to a banker on how to structure a deal, or whether it's to a, you know, another person you know in the business, just to find those answers. Because, you know, you ask a question once, you get an understanding, and then from there you can really just move on it.
Yeah. So what you're saying basically is become resourceful.
Right.
For anyone that's listening, become resourceful. Don't be scared to maybe look like an idiot a couple of times. And because, like you said, you know, we're not going to know all of the knowledge. We're not going to have all of the answers. And so ask questions.
Right.
You know, don't be scared to ask questions. Don't be scared to go and ask for help from people, maybe the people that are within your sphere, to kind of guide you at least in the right direction, to where you have enough information to be able to make a decision and make an offer on these deals. Yeah. So that's beautiful. That's amazing. That's a whole lot. That's a whole lot. A whole lot to unpack here. Let's talk about this next the business park that you just purchased. What was the opportunity that you found? What was the seller's pain point? How did you find it?
So that deal is the most difficult deal that I've ever structured.
Okay. So this is going to be a good conversation then.
Yeah, it's a long conversation, but hopefully a good one. So the way I structured this deal, and I wouldn't recommend doing this. This situation, and technically I don't own this one yet.
Okay.
So it gets this one's a little nuanced.
Yeah.
So the way this worked is basically there's a woman who manages a business park near mine at Hobby,
Okay.
who I became close with. And I noticed that there's a facility that the same guy owns a park near the one at Hobby, and then he owns another one on the North Freeway on the north side of town.
Yeah.
And so I noticed the one on the north side of town was having some troubles and difficulties, and you know, just from my conversations with her, and there's a lot going on, a lot of moving pieces, I should say, you know, just to keep things simple.
Yeah.
But the seller, I mean, everyone had tried to get this guy to sell, and he just wasn't a seller, and lives in, you know, Florida. Everyone was like, you know, it's like the fish in the marina, like everyone's casting a lure at, and it's not just seeing every lure there is and bait there is, and isn't biting anything. And so I asked her to introduce me to him when he came in town.
Mm-hmm.
I met with him, and he still got the same thing. I mean, I met with him, but I didn't feel like I was getting anywhere.
Yeah.
And I made him an offer. I made him an offer a year before I met him, I should say.
Okay.
Before I made the introduction.
Yeah.
Before I received the introduction, I made an offer. He sent me an email basically saying he wouldn't take, at the time I'd offered, I mean, I don't want to get into numbers on this one actually, but I offered about 65% of what he wanted.
Okay.
And he said absolutely not.
Right.
And so this is a year later, I get the introduction. I didn't even know if he knew it was me, associated me with the name and the email.
Yeah.
So I actually only emailed him from a different email address after that.
Yeah.
Because I was like, I don't want him to have like the two emails and like.
Yeah.
But anyways, I met with him, then I flew to Florida, met with him again. I did all of my due diligence on this property. I should say before I went to Florida.
Okay.
Because I was close with the property manager.
Right.
So I paid for a full inspection on all the units, full PCR.
What's a PCR?
Property condition report.
Okay.
Which is not cheap. Paid for a full PCR. paid for a full environmental report, did a title search, did everything
Everything.
without even discussing price with the seller.
Wow.
And my only correspondence with the seller was him turning down my offer
Yeah.
a year before.
Yeah.
So I don't know. I felt like a little bit of like an intuitive nudge. I don't really. I mean, I don't know what it was or why I felt that way. I also didn't really have any deals going on at that specific time, so I was like, there's a little like deal junkie inside of me that's got to stay moving.
Yeah.
So I flew to Florida prepared to make a non-refundable earnest money offer because I'd done all my due diligence and knew what I was dealing with and knew my price was good. So I made my offer with the non-refundable earnest money.
Did you make this offer in person?
I did.
Okay.
And he shot it down in person.
Yeah.
So it's kind of awkward because I was in Florida just getting the deal shot down.
Yeah.
But he told me if he was to find a replacement property to do a 1031,
Mm-hmm.
then he would do it. And a 1031, for people that are listening, is when you can essentially defer your taxes by selling a property and having all those funds go into another property.
Tax free.
Tax free.
Yeah.
The issue is it's a tight timeline to where
What's the timeline?
I think it's 45 days. Don't quote me on that. 45 days or so to identify 3 replacement properties.
Mm.
And then you have, I think it's maybe 125 days or something close to that to locate a replacement property.
Okay.
Don't quote me on those times. I think it's about that. But, so it's a short time frame, to make that big of a decision.
Right.
So what he wanted to do is find something first and then make the decision.
Mm.
But I didn't want to wait around for him to hopefully find something. I mean, he's owned it for 40 plus years and he hasn't done anything. So, I didn't want to just wait around with, other people trying to get the deal as well. So, what I came up with after considering his concerns and his problems and thinking of my own was, the site needs to be turned around. There's a lot of stuff going out on there that needed to be cleaned up. It needed a lot of love.
Yeah.
To say the least.
Yeah. I've seen it. Yeah.
Yeah. So what I offered was a master lease agreement and a purchase of sale agreement simultaneously.
Okay.
So basically what I said is, here's a purchase of sale agreement. I'll put down $150,000, non-refundable,
Mm-hmm.
day one.
Mm-hmm.
We sign that, and then we sign a master lease agreement simultaneously.
Okay.
So the way I structured it was I looked and I said, okay, he's not making much money off this facility right now. If I can get him the same amount of money that he's making right now without having it to do any management or even think about this property and give him time to locate a 1031 replacement, then that's a win-win for both parties.
Right.
So I created a purchase of sale agreement, put the $150,000 non-refundable down. He signed that. We signed a master lease agreement, which came out to my monthly payments. It's basically the same thing as if I would have gotten an interest-only seller finance deal at 4% interest only for the entirety.
Wow.
So the only money that I had to put in to get in this deal was $150,000.
Wow.
And so
what about all the repairs that you're doing to the property?
So the repairs and everything, I'm using the cash flow from the property. I'm bringing some additional capital, but not anything extra. I mean, I'm doing it very like piecemeal, using the property's cash flow because I created a good cash flow situation with the master lease dynamic.
Yeah.
That being said, it's an 18-month purchase agreement. And I paid for attorneys to do it correctly and make sure everything's dotted and crossed. But essentially, he has 18 months to trigger the close, and he has to give me 90 days notice to close. If he doesn't do it by month 18, then month 18 automatically triggers it. So the latest it can close is month 21.
Got it.
And I have to be ready. If I can't close in 90 days, I lose the deal.
Yeah.
But the good
How do
thing,
you stay ready on this deal?
so I mean, I have backup plans in place. I have my hobby business park deal, for example. I have really low debt balance on that. I know exactly what I can refinance it at and get liquidity there and bring it to close. So I have backup plans in place. What I think will happen, every month that goes by, I'm stabilizing it further and further,
Right.
increasing the valuation every month. So what I'll do once it's time to close, hopefully like close to month 18, I'll close it with an acquisition loan just for like semantics,
Mm-hmm.
and then 2-3 months later refinance it off of value,
Right.
and not have, because that's a very clear value. The equity's there,
Right.
the deal's there,
Right.
and it's stabilized at that point too.
Right.
So I'm basically getting to stabilize it under the master lease timeline. He gets the 1031 ability, and I get in it with very little money.
Wow.
So
Wow.
that's 100,000 square foot deal with a billboard.
With a billboard, yeah.
And
I think all this goes to show the ability to be creative in real estate, right? And understanding again the motivation of the seller, right? And putting together something creative that makes sense for you and makes sense for him.
Yeah, and if you think about it logically, it's someone who's at a later stage in life who, for example, has owned it for a long period of time. They have a low cost basis. They've depreciated it down, to pretty much zero. I mean, the way that works is, every year you're depreciating structure.
Right.
And so eventually, you've depreciated it all, which means you got a huge capital gains tax bill if you were to sell. So a lot of times they don't want liquidity, and you don't have liquidity.
Right.
So you work
It's
it
a
out.
win-win.
It's a win-win. So
Yeah.
you don't have liquidity. I mean, it's not, you don't want to, you can get in a lot of deals without having to use your own cash because they don't want your cash a lot of times right away.
Right. What they want is to defer those capital gains taxes.
Right. So whether it's seller financing, whether it's something more creative like a 1031 where they don't want to just cash out,
Yeah. Let's talk about let's talk about deferred. You mentioned depreciation, right? What does depreciation mean?
So depreciation, I mean, that's kind of per the tax code. You're able to, essentially depreciate an asset every year.
Right.
And what I've started doing is bonus depreciation, like accelerated depreciation, where you're able to essentially, do a study on the property and forward the depreciation to the first couple years.
Are you doing cost segregation?
Cost segregation, right? Where you're getting the majority of it in the first couple years. I mean, you're not avoiding taxes. You're essentially just front loading it. So it's time value money deal.
Got it. And can you explain the cost segregation study?
Yeah, so the cost segregation study, they basically break down all the different elements of the structures and like the depreciable life on, all of the different components, and they come out and they do like a detailed report of everything, and then they give you kind of what what you can depreciate on an annual basis.
Right.
I'm not smart enough to put one of those together, but I can tell you what you can depreciate annually.
Yeah. I mean, but the actual cost segregation study, what they do is that they look at like every component of the building. Correct.
And they break, they got all the different, all the different compartments have like different depreciable lives that you.
So like doors, for example, the structure, the windows, maybe everything that's in the building, the roof. So they're able to create a whole study of the entire building and then tell you, okay, this is how much you're able to depreciate on a yearly basis, so that you don't have to pay any taxes up front.
Correct.
You can pay it on the back end of the building.
Exactly. Right. Well, or you just do 1031. So you depreciate it, you front load it, you depreciate as much as possible, and then if you want to sell it, you just do a 1031.
Beautiful. And this is one of the biggest, I think, kind of cheat codes in real estate, I think, that exists, right? It's all about buying assets, depreciating so you don't pay taxes, and then selling it, and then basically you're not paying taxes, you're just pushing those taxes aside.
Right.
It kind of seems like a cycle that keeps on going and going. How do you get out of this cycle eventually?
So I mean, I think there are a ton of different strategies in real estate, and I don't think anyone is right or wrong. I think it's just a matter of timing.
Mm-hmm.
So I think there's a time and place that maybe you do cash out of one, and you have enough depreciation on the other ones to offset the gains that you're making on that one sale, for example.
Mm-hmm.
The other thing you can do is just cash out refi. Mm-hmm. That's the method I've been using that I like, more, because my goal is to just build a really long-term portfolio.
Right. So not necessarily doing 1031s on your end. It's more so just doing cash out refis.
Correct.
Yeah.
But don't get me wrong. I think like the idea that like never sell anything for any reason whatsoever. Like I don't really subscribe to that. Like I think there's a time and place that if it makes sense to sell something, but unless I have a reason to, I don't.
Yeah. So you keep the assets until maybe you get a good enough offer for it to make sense to sell it.
I mean, the other thing is, at least, and this is all stuff that I've learned pretty recently. I mean, in terms of like the outdoor storage assets, um, your refinance and debt terms become significantly better, and you get a lot more options the bigger your deal size becomes.
Right.
So my plan with the outdoor storage sites, um, I should have, close to 25 million dollars of outdoor storage by like February 2026.
Mm-hmm.
So I plan on doing a portfolio refi on all those sites, and that's how I'll get the most attractive debt terms.
Yeah. What kind of debt terms are you gonna?
So I mean, it depends clearly on where the market's at there.
Right.
I mean, I guess just for uh, some reference points, like today, I'd be probably looking at like 6.25, 6.3%.
And that's on the 30-year loan or
25-year M. Yeah.
24-year. Now, do you have to do refinance every 5 years also on those?
So yeah, I mean, it'll be 5-year. I mean, it depends on the terms. There are a lot of different options that you can do. I mean, there's CMBS lending, there's life cos, there are a lot of different.
What are those? What does that mean?
So I mean, life insurance companies are one option that offer lower rates, and they're more flexible in terms.
Yeah.
CMBS loans are commercial mortgage-backed security, and so that's sold essentially to the bond market.
Right.
And so the rules, they're a lot more strict. Like you have a lot less flexibility. You can, if you're not careful with those, like there's no mercy on the other end. So
Yeah.
you just got to be careful and make sure you know what you're signing up for with those kind of deals.
Where do you get the knowledge to make sure that you make the right decision on the right loan to choose at that point?
So, I mean, I think a lot of it is talking to people
Yeah.
who have more experience than you.
Like other owners or maybe
Yeah.
attorneys or...
Well, I mean, I think an attorney is always good to, read legal jargon that you're unfamiliar with, but more so like the strategical element for me was talking to people who were more experienced in real estate than me, who I look up to and have relationships with,
Yeah.
and asking their thoughts on what I should do or what I shouldn't do.
Yeah.
Just because, I mean, I think some things are just, it's a matter of experience. And like once you make the wrong decisions, it's easy to tell someone else what not to do.
Yeah.
And it's better to hear it from someone else than have to make the wrong decisions yourself.
Right.
So.
No, I agree. Well, man, I think now, from the beginning of this podcast to now, I think I have a lot more knowledge as far as like your experience and like how you've actually gotten to this point, right? Like it doesn't sound like it's came easy to you.
Yeah, and I still make the wrong decisions. I mean, I still get, like, there's one deal in particular that I've had for a lease for over 6 months now.
Right.
The deal is it's not a terrible deal from a purchase price standpoint, but it hasn't gone according to plan by any means.
Yeah.
It's sat vacant. And it's the only deal I have right now that's like that, but it's a thorn in the side, and they happen.
Yeah.
And it's a batting average, and not everyone's going to be perfect, and there's going to be, frustrating things that happen along the way.
Right. And understanding that going in is probably what gives you or maybe it gives you the fortitude to keep going, right? Because you know that you're going to have some good properties, some great properties, right? Some grand slams, and maybe some thorn in the sides, like you said.
Yeah.
So as long as it averages out to make you be in the green, I think that's all that matters when it comes to real estate. So, man, that's amazing. Let's talk about deal sourcing, because I feel like it hasn't been something that came by chance now at this point. What is your competitive advantage when it comes to deal sourcing?
Yeah, so I think the biggest competitive edge that I've had is just being able to apply the same work ethic that I did to wholesaling to the commercial side.
Right.
And I think that a lot of the commercial world is it's been handled the same way for a really long time.
Yeah.
In terms of how brokers interact, how they find deals, who they give their deals to. And there hasn't really been a lot of people from the residential wholesale community entering into that arena.
Right.
And I think like the unconventional ways of just going direct to seller, for example, and not having a broker interact with the seller and then bring the investor or the institution the deal. It's, being able to go directly to the seller, apply the same, the same tactics that you do in residential, the same stuff that's standard in residential becomes creative and unique in like the industrial world.
Right.
Which, I mean, if anything, you would think it becomes easier. You have less people to compete against that are doing your strategy.
Right.
So really it's like it's being like an octopus, thinking like there's not one secret sauce. The same way anyone that does wholesaling houses, like there's not one thing that you just do that just like, generates a lead automatically. You might get one from door knocking, you might get another from cold calling, you might get another from email blasting, you might get another from sending direct mail. And all of those strategies that I just mentioned are the ones that work with outdoor storage as well.
Right.
Whether it's going in person and going to a site and just figuring out who's who and trying to talk to a GM and maybe he introduces you to the owner. And sometimes people just curse you out and you get in your car and you go to the next one,
Yeah.
So like sometimes like door knocking and just meeting people in person can be really effective.
Mm-hmm.
Cold calling, sending direct mail. And then like I think there's always an element even on top of that to just keep adding to the creativity.
Right.
Handwritten letters. I mean, I even sent chocolates
Oh yeah.
in the summer. It's not a good idea. I thought about it after the fact. I was like, yeah, I don't know. I hope they got it quickly. But I didn't get any responses to that.
Yeah.
So like sometimes you try things and you're like, it's
that didn't
trial
work.
and error. Yeah.
Yeah. So there's not one strategy per se.
No,
that's probably the most effective.
There's
you
not
have to
one
do it all.
strategy. You just got to try a bunch of things, and then even reaching out to residential realtors, for example. If you're a realtor or if you're a wholesaler, and if you're plugged into the residential community, describing what it is that you're looking for.
Mm-hmm.
You're looking for single tenant sites. You're looking for, and just like really, deal criteria. 10 to 30,000 square feet of warehouse. And 2 to 10 acres of land.
Right.
With the majority being stabilized with, crushed gravel or asphalt or whatever it may be. And describing that to residential realtors and saying, hey, if you come across this, like, let me know.
Yeah.
Not to commercial brokers because they're already going to have like someone to give everything to. And
right.
But, there's opportunity because I've seen even on HAR, residential realtors list an outdoor storage site.
Really?
Just looking at it, as land,
right.
not really knowing what to do with it.
Right.
Maybe it's their friend, maybe it's their neighbor,
right.
Maybe it's their relative who's selling it. They don't know where to put it. It's not on LoopNet, it's not on CoStar, it's just on HAR.
Wow.
So even scanning for those kind of opportunities and telling other realtors in advance, like you're the person to bring those to.
Right. So basically, like you said, very much having an octopus, right? Having different marketing sources out there, always consistently finding you leads and opportunities to get into these outdoor storage spaces.
Yeah, and consistently trying to add tentacles to the layer. Because if you have 8 tentacles and you're getting 1 lead from each every month,
that's still 8 leads,
right? Yeah. So. I think it's having just as many prongs and as many tentacles in the water as possible.
Do you have any sort of KPIs in terms of like how many leads it takes to get a deal?
I am so unorganized that if anyone followed those kind of metrics like you do, I think they'd knock me out of the park.
Yeah.
Because that's my Achilles heel is like organization. I'm very much like a hunter on the deal front.
Yeah.
So I'm just out there wanting to like find deals all the time and I don't like to go back and like keep track of like all my data, even though I should. You go to my office, I just have a million notes all over the table, and sometimes I just try to put them together and get kind of organized. But I definitely could use something of that nature. But the short answer is no. Yeah. Even though I know I should.
Yeah. No. And that's something that I think that I obsess over is very much understanding the data and understanding the metrics on how to track success. Because when you have success, and you go back to the data and you look at it, then you can replicate it, right? Then you can create a much more scalable outcome that you can say, okay, if I make this amount of effort on this front, then I can get X amount of results. Yeah. Right. I think that's important when it comes to business, right? But that's something that we can definitely talk about later. Yeah. That's cool, man. That's awesome. So for anyone that's listening to this, how can they start doing this deal sourcing and start finding these opportunities? Just everything that you just mentioned.
I think it's, especially if you're already in if you're a residential realtor or if you're a wholesaler, you know, you don't have to really change anything about your personality or, you know, where, you know, you don't have to do anything. You can just be yourself and
Yeah.
approach these sellers the same way you would anyone else.
Right.
And the only thing is like, you shouldn't have an offer the first day.
Right.
I will say that's a big difference. You're not dealing with people most of the time
Right.
that need to sell today.
Right.
You're dealing with people who you build a relationship with, and it takes a little bit of time. You know, maybe instead of a deal that closes in a week, it takes a month, 2 months, 3 months. But you build that relationship, and then the offer should come, you know, later once the relationship is more established.
Right.
So the first phase is just, you know, trying to find a time to meet them, getting the walk to walk the property, getting to know them, and then coming to them with an offer. But you don't need to be prepared at all with a number the first day that you go to meet them.
Yeah.
Or the first time you call.
And I'm really glad you said that, because I feel like for anyone that's listening to this, it could be possibly overwhelming, right?
Yeah. I mean, even if, you know, for example, if you got a hold of someone, built a little bit of a relationship with them, scheduled a time to walk the property, you know, hypothetically, if you wanted me to join with and like walk the, you know, just to kind of add to the experience level and talk as needed, maybe even on just the first tour that you go on.
Yeah.
You know, I'm happy to be as involved or as uninvolved as, you know, anyone would like me to be.
I love that. That's a ton of value that you're offering there for anyone that's listening to this. What are your target markets right now? Is it just in Houston that you're looking for? Or are you thinking about maybe expanding to other markets here in Texas?
So, I mean, right now I'm looking at Houston, Austin, Dallas. I mean, really, I-35, 45, in between, you know, Houston and Austin, Houston and Dallas.
What about San Antonio?
I mean, around San Antonio, too. I personally haven't started looking too much over there, but I'm definitely open to that area.
Yeah.
And, you know, soon enough, I'd like to just be in, you know, the top MSAs.
Yeah, for sure.
Just with a very, you know, the focus is very much, you know, that sweet spot of 2 to 10 acres, stabilized buildings of 10 to 30,000 square feet. So just staying in that kind of clear buy box.
What about business parks? Are you looking to buy more business parks also?
Not today, but in a month or, you know, 2 months or so, once I get a little further along here, then yes.
Yeah. Okay, cool. In the same markets too, you'd be open to look at it?
Yeah, in the same markets. And, you know, from a deal sourcing standpoint, like now's the time to plant the seeds. So just because it's not time to close today doesn't mean that now's not the time to start, you know, building those relationships, because those deals take a while.
Right.
And they're, you know, the business parks you're dealing with investors. So I'll say that is like the nuance there. You know, you're not dealing with a mom and pop owner user. You know, mom and pop owner user is more similar to a residential homeowner.
Right.
As opposed to an apartment owner.
Right.
You know, a homeowner, they're not looking at the house from an income standpoint. They're just looking at it as a place they've lived for a while.
Yeah.
And
it goes the same for the outdoor
storage owner user. Yeah, it's the same thing. You both are dealing with people that have real estate as a byproduct of some other element of their life.
Yeah.
You know, the house is a byproduct of just a place they've been living.
Yeah.
Outdoor storage is just a place they've had their business, but neither have it for a income use.
Yeah. But from that standpoint, from an owner-user standpoint, it might be easier to start the conversation with someone that has an outdoor storage space versus someone that has the business park, basically.
Absolutely.
Got it. And when it comes to business parks, I think something also to maybe talk about is the different kinds of business parks out there. I think you've mentioned something like low bay.
Yeah. So they're referred to as shallow bay, small bay.
What are the difference between?
So I mean, there's the term business park. You know, you can have business parks that have, you know, 50,000 square foot units or 20,000 square foot units or 5,000 square foot units. The ones that I look at primarily are, you know, like around 1,500 square foot units.
So small units.
Small units. I mean, the trade-offs are the really small units are the easiest to lease because you have the most businesses that, you know, naturally can afford to pay those rents.
Right.
But you're dealing with smaller companies, so they're more management intensive. There's more nuances that go on with the management, with the leasing, more tenants.
Can you normally lease a smaller unit for more price per square foot on the rents?
Yes. Yeah, so you get significantly more of a, you know, there's a higher price per foot on the rent. There's also a higher replacement cost. Replacement cost, being the cost for someone to replicate that same structure. And that's really the barrier that you have protecting the value and protecting the rents.
Yeah.
Is, can someone come across the street and, compete against me, essentially?
Right.
And, each unit in a business park, I mean, it sounds just trivial, but it's really important, is each unit has its own meter.
Yeah.
Each unit has its own restroom, its own office build out. So these are, instead of having, a 100,000 square foot facility, let's say you have, four 25,000 square foot tenants. That's 4 office build outs,
Yeah.
4 restrooms,
Right.
four meters. If you have, 70 tenants,
Yeah.
for example,
70 meters.
yeah,
70
70
restrooms.
offices, 70. Yeah, so it's harder to build. I mean, it's more expensive to build out. So you have a higher replacement cost, but you have a higher price per foot. You can, facility can make more,
Yeah.
but there's more management that comes along with it.
Right.
And if you're taking a facility that's, been neglected for a while, you've got 70 tenants that, let's say it's 60 tenants that got to go. You got to fix all 60. It's similar to a big multifamily, repositioning.
Right. So basically, the capex, the capital expenditures that you need to put into 70 tenants business parks is going to be a lot higher than, let's say, for example, maybe just like a 4-tenant, 100,000 facility, for example.
Correct.
Yeah.
And the leasing front, getting out, essentially problematic tenants and all the things that accompany that.
Yeah. Wow. Well, that sounds all very interesting, man. I think we've covered a lot. I think this is definitely something to unpack for someone that's listening. What else can you share about all of your experiences when it comes to this space that you're in right now?
I'd say that, I think the industrial world for a lot of people is daunting and confusing, and there are a lot of terms and intricacies that, they might not understand, and nobody does when they're first starting.
Yeah.
And I think that, the biggest thing I've learned in real estate as a whole is, you just have to keep moving. And as long as you keep pushing forward, even if you're hitting roadblocks or you're bouncing off walls or you're meeting different people, like, you will get to the destination.
Yeah. Yeah. I love that. I think that's such an important thing to consider or to keep in mind is, as long as you don't give up when it comes to real estate, you can be very and extremely successful, right? It's all about just managing where you're at, handling those objections, handling those roadblocks, pushing through them, and then just getting to the next phase of your career. Right.
And so, I think one of the things about commercial, different than residential, you need volume, especially if you're wholesaling.
Right.
You have high marketing costs, and you have to flip a lot of houses, or you got to wholesale a lot of houses.
Yeah.
With commercial, you can be a lot more focused, and you never know what tomorrow is going to bring.
Right.
And it can be a deal that, changes everything.
Yeah. So you just never know what's right around the corner.
Right.
Just keep on going.
Right.
I love that. Well, Jake, how can someone find more about you if they have a deal, or they have maybe someone that they're talking to, a potential lead that they need help to either evaluate to maybe go and walk the property? How can they contact you?
Yeah, so I don't know if you can post like a phone number with the episode, but
yeah,
it's 713-878-7093.
Okay.
And you can go to allumaholdings.com.
Yeah.
That's ALOOMAHOLDINGS.com.
allumaholdings.com.
That's right.
Got it. And what does Alluma mean again?
It's a beam of light in Hebrew.
A beam of light in Hebrew, yeah.
Shining on all the deals.
Yeah. Lighting up the industrial world for everyone out there.
Right.
Yeah. So cool, man. Well, I think this episode's been very enlightening for to shed a lot of light in the industrial space. I think there's not a lot of people that's doing that. Most people are either in residential or in multifamily or just like in kind of regular commercial. Some people do venture a little bit into industrial parks, but not to the level or to the degree that you're in, where you're just hyper focused on it. So I think you found a great niche in the real estate world, and I think I would definitely consider you as someone, a leader in the space, right? And someone can can come to for knowledge, advice, or just to have a conversation on things. So
Appreciate that.
yeah. So I think anyone that's listening to this will definitely get a lot of value, and hopefully, you might be able to do some deals with some of the listeners here. So
Awesome.
yeah, man. Well,
Yeah,
thanks.
hopefully.
Thanks so much for being here. I appreciate all your time, brother.
Thanks for having me.
Yeah. All right. Cool.